In the last 2 minutes of the market at 3:58 p.m., we detected unusual options activity on Google Alphabet, ticker symbol GOOGL, today, January 26. And since Google will be reporting earnings next week, Tuesday, January 30th, after the market closes, we will be analyzing 3 sets of unusual options activity data, which represents the trades of wealthy investors, so we understand and find out how they are trading Google for earnings. Are they bullish or bearish? And then we will show how we set up our earnings trade based on how the rich are trading Google for earnings. So without further ado, let's get to the data analysis. We did want to point out, as the first set of data happened actually 2 days ago. We want to point them out because they actually also happened today at 3:31. March 15, the 150 strike puts and 150 strike calls. You can see 5,000 of them. So this exact trade was also being done on January 24. We can see here for the 150 strike calls and puts. The put side here, you can see the volume of 5,000. We know these are opening trades because the open interest was only 1,900. Okay, and for this trade, what they were doing here, this is what the trade is. Okay, so we believe they were selling the 150 strike puts and they were buying the 150 strike calls. When you analyze this trade, you can see that this is a long synthetic trade with a positive 100 delta. So this is a bullish trade. And not only is it bullish, it also requires a lot of buying power because they sold the 150 strike puts, essentially saying they're willing to own Google at $150 a share. So we multiply by 100. That's $15,000 of buying power per contract. And so since they did 5,000, this is $75 million a trade. Okay, so this investor did put down $75 million on January 24th, 2 days ago. And it seems like they just added another 5,000 contracts, which would be another $75 million. Okay, but this is there's a possibility they also may have closed it though. Okay, so that's something we still need to confirm that data. You can see here the open interest is 8,000, so that is greater than 5,000. But as we explained, that on January 24, those 5,000s, the first 5,000 came in just 2 days ago. Okay, so if you do want to be updated, if there are any other updates, make sure to subscribe and hit the bell icon so you get notified if we find out that the data was going the opposite direction. Okay, so let's go to our second set of data. It's actually seen on January 24 as well, but for a different date. So on January 24, February 2nd expiration cycle, we detected these 157.5 strike calls being bought to open. You can see there was 12,000 volume, much greater than the open interest of only 751. Right, so this is clearly a bullish trade by buying call options to open. Okay. And now let's go to our last but not least, the one that happened just the last 2 minutes. February 9th and January 26th. Now we already know that January 26th expires today, so they were closing these trades and rolling them to the February 9th. The 162.5 strike calls. And when we take a look at the February 9th, notice here the 162.5 strike calls. 28,000 contracts. This volume, very, very high in comparison to the open interest of 534. So again, we know these are being bought to open. And this is what it looks like. These call options, clearly bullish with a positive 19 delta for each call option. Okay. The other, the one that we were mentioned prior on February 2nd, which is also the expiration cycle of how we traded Google. As we mentioned, were the 157.5 strike calls. Okay, so this is what it looks like. Okay, so these three sets of unusual options activity, all bullish. Okay, and one thing to note is that because of earnings as a risky event, we typically always hedge our earnings trades. And this is what we are doing for Google. These are our trades. You can see them on the screen. February 2nd, this is our strategy for the 160 strike calls. We sold 2, and then we bought the 162.5, one of them, and we bought the 155 strike calls. And so when you analyze this trade, you can see that this is a broken wing butterfly trade going long with a positive delta. And for our hedge, as we explained, because earnings is always risky, we sold the 145 strike puts, 2, and then we bought the 144 strike puts and the 147 strike puts. And so we have a trade that looks like this. This is a double butterfly trade, 2 butterflies. You can see here that if Google were to go down, we could potentially be profitable if it's around this price range, 145. Even if it's not, if it continues to drop, our loss is reduced here. Okay, the x-axis is the price of Google, and the 0 on the y-axis is the profit. If the lines, the purple and the blue lines are above, that's a profit. If it's below, that's a loss. Okay, so that's why it says negative here. And it starts to turn positive as we move upwards from where Google currently trades at 151. Okay. So you can see our trades. The cost of the trade is about 110 plus 39, which is 149. Okay, so this is how we will be trading Google for earnings. We are leaning bullish based on the data. And as usual, these are risky trades. And if you are more interested in lower risk, higher probability of profit trades, then go to our website where we share with our members, and you can learn how to gain access to our trades in the stock market using this type of analyses and different option strategies that we use depending on the current market conditions and where the stock is and its Greeks. And as usual, please smash the like button. Let us know in the comments below what you think will happen to Google. Will it go up or down? And have a wonderful weekend. Take care.